So PepsiCo was talking about it. It's there in the inflation data for everybody to see. There are inflationary impulses within the United States, and much of it is being driven by what is happening with freight rates. Certainly PepsiCo talking about that in terms of its numbers a little bit earlier on. I suspect you're going to hear trucking costs being mentioned, freight costs being mentioned as we work our way through this earnings season on a lot of calls. You can see what's happening here on this chart. This is a chart that goes back to 2016. These are truck rates in the United States. They take out fuel because obviously that's a factor in all of this. But as you can see, this is where we are now, this huge spike. But the idea is that as we go into next year, that may start to fade. That's the transitory nature, potentially, of all of this. One company that's certainly going to be well attuned to all of this is the XPO spin-out, GXO. It has had its investor day today. Mark Manduca, GXO's chief investment officer, joining us now to give us his take on A, this chart, and B, how the day went. Mark, what are you telling investors about what the environment is going to look like going forward for logistics, for rates? Are they going to stay elevated? Is this something that we can rely on, or is this going to fade? And if so, how does the business compensate?
Guy, great questions. Thank you so much for your time today. So a couple of things. You mentioned, obviously, the broader supply chain. Clearly, we manage 900 or so warehouses. There are complete problems, no doubt, in the global supply chain right now, and I agree with you on that. But the most prevalent issue, I think, is that we're seeing shortages of containers, partially driven by imports rising, as you've been documenting, and obviously exports falling. And that's been driven, as you know, by consumer buying patterns that have been changing. So until those buying patterns reverse, until you start going to the cinema again rather than buying goods online, and until our flying patterns change, obviously you'll know that half of the world's available cargo capacity flies in the belly of passenger planes. So long as those planes aren't flying, you're going to have a bit of a logjam in the system. And the system right now is jammed from arm to arm. So I don't see it changing anytime soon.
Mark, are you noticing any kind of demand weakness at any point as prices continue to rise? Have we hit that moment yet where consumers or businesses say, I can't pay this, forget it?
This is a very different type of problem. This is not a consumer drought so much as it is a consumer shift in buying patterns, and therefore the demand is definitely there. What we're seeing naturally, and we're seeing this coast to coast, not just in the port of Los Angeles, but across both sides of the US and even in the UK, labor inflation is increasingly becoming an problem for our customers. And that, I think, is here to stay. Inflation volatility from our side of the fence clearly drives our customers to want to outsource to third-party logistics providers like us. Labor inflation obviously causes people to want to have more automation and robotics. So it actually serves our purposes in making sure the in-sourced market becomes the outsourced market. But it's definitely a problem we're seeing on the ground, less of a demand problem, Alex.
What does this mean for margins? You talk about that need to automate. Presumably that is going to improve margins. Obviously, there's CapEx up front on that. But what do you see going forward in terms of the evolution of margins, given the bottlenecks we see now maybe fading? How does the margin picture look? How do you get, for this new firm, this new spin-out that you're going to be doing from XPO, how do you get margins within your business up to, say, the kind of numbers that Deutsche Post are enjoying?
Yeah, you're totally right, Guy. I mean, there's a lot of excitement, as you can imagine, post our Investor Day about the type of business that we have on our hands. 900 warehouses, 100,000 teammates. We're a global leader in the space and very worthy, in my view, of a high teens EV to EBITDA 2022 multiple. What I would say is this, and that is we're a rare breed of business, and we can manage those inflation problems primarily because they're actually worded in our contracts. We have inflation pass-through on the vast majority of our contracts. So it doesn't really feature as an issue for us. If anything, we're providing a real asset, a real service, so that works through our top line and actually helps us, if anything. For us, this is a rare breed of business, as I mentioned, high revenue growth versus peers, high EBITDA growth versus peers, and return on invested capital of 28%, and we're producing free cash flow as an e-commerce play. It's very rare to see our type of business in the market, and we would hope for margin expansion going forwards.
Mark, always a pleasure. Thank you very much indeed. Mark Manduca, GXO CIO. Thank you very much indeed.